In 2011, 2 European prime ministers were removed from office within the same month. Not by elections, not by coups, by bond yields hitting 7%. Silvio Berlusconi in Italy, George Papandreou in Greece, both replaced by unelected technocrats, both removed because bond markets lost confidence. Democracy didn't fail. It was overruled. Welcome to Financial Rewind. I'm here to show you how the world actually works beneath the surface. And today, we're exposing the $130 trillion empire that decides which elected governments survive and which fall regardless of what voters want. This is the bond market, the invisible electorate, the shadow parliament that's been quietly running your democracy for 40 years, and most people have no idea it even exists. London, 1,976. Britain is dying. Inflation rages at 25%. Unemployment climbs. The pound collapses. The Labour government, elected on promises to protect the welfare state, has run out of money. Prime Minister James Callaghan needs a loan. £2.3 billion from the International Monetary Fund. The IMF agrees. But the money comes with conditions. Cut public spending. Slash the deficit. Make Britain safe for bond investors. Callaghan goes on television and delivers the death notice for British socialism. We used to think you could spend your way out of a recession. I tell you in all candor that that option no longer exists. Why not? Not because it's economically impossible. Because bond markets said no. British voters elected Labour to expand the welfare state. Bond markets demanded its dismantling. When votes collided with bonds, bonds won. No coup, no violence. Just interest rates rising until borrowing became impossible. Just bond traders selling UK debt until the political cost became unbearable. The mechanism was invisible. The power was absolute. A new era had begun. One where governments would learn to ask permission from people who never appeared on a ballot. Here's what they don't teach you in school. Modern governments don't run on taxes. They run on borrowed money. The United States government spends $6.5 trillion annually. It collects $4.9 trillion in taxes. That $1.6 trillion gap? Borrowed. Every single year. To borrow, governments issue bonds, IOUs, promising repayment with interest. Those bonds are auctioned to investors. Pension funds, insurance companies, foreign governments, hedge funds. The interest rate depends on demand. High demand, low rates, government borrows cheap. Low demand, high rates, borrowing becomes expensive, sometimes impossible. And here's the trap. Bond markets react instantly to policy announcements. Announce massive spending? Bond traders assume higher deficits. They sell government bonds, prices fall, interest rates spike. Announce austerity? Traders assume lower deficits. They buy bonds, prices rise, rates drop. It's automatic, invisible, unaccountable. The government can lie to voters, spin promises, make speeches, but it cannot lie to bond markets. Because bond markets have something voters don't, the power to make governing financially impossible. If bond markets decide a policy is too risky, they stop buying debt. Or they demand interest rates so high that debt service consumes the entire budget. Either way, the policy dies. Not because it's unpopular, not because it's unconstitutional, because it's unaffordable. And affordability is determined not by the people who vote, but by the people who lend. Washington, D.C., 1,993. Bill Clinton just won the presidency. For 12 years, Republicans held the White House. Infrastructure crumbled. The middle class struggled. Clinton ran on transformation. Rebuild America. Fix healthcare. Invest in education. His economic team delivers the first post-election briefing. The numbers come back. Clinton's face goes pale. You mean to tell me, he says, voice shaking, that the success of my program hinges on the Federal Reserve and a bunch of fucking bond traders? His advisor, James Carville, captures it perfectly. I used to think reincarnation would bring me back as the president or the pope, but now I'd want to come back as the bond market. You can intimidate everybody. What happened? Clinton announced his spending plans. Bond traders calculated the deficits. Within weeks, 10-year Treasury yields jumped from 5.2% to 6.7%. That 1.5 percentage point spike meant tens of billions more in annual interest payments. It meant Clinton's domestic agenda would explode the deficit beyond sustainability. Clinton had a choice: fight the bond market and watch borrowing costs spiral, or abandon his promises and embrace deficit reduction. He caved. Infrastructure died. Healthcare was gutted. The progressive mandate that won him the presidency was sacrificed to bond market confidence. The bond market hadn't organized. No meetings. No conspiracy. Just thousands of traders independently reaching the same conclusion. Too much borrowing, too much risk. Sell. The distributed veto. No one in charge, everyone in control. And Clinton learned what every president since has learned. You campaign for voters, you govern for bond traders. But removing campaign promises is just the beginning. The bond empire doesn't just constrain governments, it removes them. Back to Italy, 2011. Silvio Berlusconi is prime minister, scandal-plagued but democratically elected with full parliamentary support. Then bond yields spike. Italian 10-year bonds hit 7%, the level that forced Greece, Ireland, and Portugal into bailouts. Berlusconi hasn't lost a vote, hasn't been convicted of anything, still has his majority. But within 72 hours, he's forced to resign. His replacement? Mario Monti, an economist, a technocrat, never elected to any office, appointed directly by the president to restore market confidence. Monti immediately implements everything. Bond markets demanded. Pension cuts, labor reforms, tax increases, spending slashes. Italian voters didn't choose this. They didn't vote for Monti, they didn't vote for austerity, but bond markets did. And in modern democracy, bond markets outrank voters. Greece, same year. Prime Minister George Papandreou announces a referendum let Greek citizens vote on whether to accept bailout conditions. Bond markets panic. Yields explode. The European Central Bank threatens to cut emergency funding to Greek banks. Papandreou cancels the referendum within 48 hours, then resigns. His replacement? Lucas Papademos, another unelected technocrat, another bond market appointee. 2 democracies, 2 elected leaders removed, 2 technocrats installed to satisfy bond traders. This is the quiet coup. No tanks, no generals, just borrowing costs rising past sustainability until democratic governments have no choice but to surrender. And it's completely legal. It's just markets pricing risk. But the effect is identical to a shadow government with veto power over elected officials. So who controls this empire? Not a conspiracy. A distributed network managing $130 trillion globally. More than world GDP. More than all stock markets combined. The biggest player? BlackRock. $10 trillion in assets under management. More than the GDP of every country except the U.S. and China. When BlackRock's CEO Larry Fink speaks, markets move. When markets move, governments adjust. In 2018, Fink sent a letter to corporate executives demanding focus on social responsibility. Companies scrambled to comply, not because he threatened them, because BlackRock's vote determines whether CEOs keep their jobs. But here's the thing. Fink isn't trying to control governments. He's trying to protect his clients' portfolios. The line between risk management and political power disappears when you're managing $10 trillion, and Fink isn't even the whole market. Pension funds in California, sovereign wealth funds in Norway and Abu Dhabi, insurance companies in Tokyo, central banks in Beijing and Frankfurt, all buying and selling government bonds based on risk assessments, none coordinating, none conspiring, but collectively, they decide which governments can borrow, at what cost, under what conditions. It's power without authority, influence without accountability. The most sophisticated control mechanism ever devised. Make the cage invisible, and people won't realize they're trapped. Greece, 2015. This is where the mask comes off completely. The radical left party Syriza wins a landslide on an explicit platform. Reject austerity, renegotiate the bailout, restore sovereignty. Prime Minister Alexis Tsipras tries negotiating with the EU and IMF. They refuse, accept our terms or face complete collapse. Tsipras calls a referendum. Let the people decide. Accept these conditions or reject them. 61% vote NO, overwhelming rejection of austerity. 1 week later, Tsipras signs a deal with even harsher conditions than the ones voters just rejected. Why? The European Central Bank threatened to cut emergency liquidity to Greek banks. Without it, every ATM in Greece would go dark within days. Tsipras could have his democratic mandate or a functioning economy. Not both. He chose survival. The bond market's terms were the price. Democracy voted, bond markets vetoed, and the Greek people learned their sovereignty existed only as long as creditors allowed it. A German finance minister said it explicitly during the crisis. Elections cannot be allowed to change economic policy. Read that again. Elections cannot change policy. That's not democracy with constraints. That's democracy as theater. The real decisions happen in bond markets, central banks, creditor meetings. The ballot box is real. But it's not sovereign. The bond market is sovereign. Here's the number that reveals everything. In 2024, the U.S. government paid over $1 trillion just in interest on debt. Not defense, not health care, not education. Just interest. More than the entire defense budget, more than Medicare. Just the cost of borrowing. Japan pays hundreds of billions annually. The European Union the same. And here's what makes it sustainable. Central banks have quietly replaced bond markets as the primary lenders. The Bank of Japan owns nearly half of all Japanese government debt. The Federal Reserve owns trillions in treasuries. The European Central Bank does the same. It's called quantitative easing. But it's really monetary financing central banks creating money to buy government bonds, which sounds like freedom. If central banks buy the bonds, governments don't need private bond markets anymore, right? Wrong, because central banks impose their own constraints, inflation targets, balance sheet limits, exit strategies that never quite materialize. The leash just changed hands, from bond markets to central banks, but it's still a leash. And when central banks step back like they did in 2022, bond markets reassert control instantly. Yields spiked, governments panicked. The UK had a mini-crisis when bond markets rejected Liz Truss's tax cuts. She lasted 49 days as Prime Minister. Not removed by voters, removed by bond yields. The empire never left. It just operates through different channels now. There's a term bond traders use for themselves, bond vigilantes, coined in the 1,980 seconds to describe traders who enforce fiscal discipline by selling bonds when they perceive reckless government spending. The language is almost heroic. Vigilantes, keeping governments honest, preventing irresponsibility. But vigilantes don't answer to law. They enforce their own justice. Bond vigilantes don't answer to voters. They enforce their own vision of fiscal responsibility, which always means austerity, social spending cuts, policies protecting creditor interests. They're not elected, not accountable, but they have more power than most elected officials. Ed Yardeni, who coined the term, said it clearly. If fiscal and monetary authorities won't regulate the economy, the bond vigilantes will. The bond market sees itself as a regulator of governments. But who regulates the regulator? Nobody. Voters don't regulate bond markets. Governments don't regulate bond markets. They need them too desperately. The bond market regulates itself, and its only goal is return on investment. Not justice, not equality, not democracy, just returns. And here's why this matters to you personally. The bond empire makes inequality structural. When governments face fiscal pressure, they have two options: raise taxes or cut spending. Raise taxes on the wealthy, capital flight. Rich people move money offshore, corporations relocate, bond markets punish you with higher rates because you're scaring capital. Cut spending instead, social programs disappear, public services deteriorate, infrastructure crumbles. But bond markets reward austerity with lower rates. The incentive structure is clear. Policies helping the wealthy are financially sustainable. Policies helping the poor trigger bond revolts. After 2008, governments had a choice: bail out banks or let them fail. They bailed out banks with public money because bond markets made it clear: let banks fail and credit markets freeze globally. Banks got trillions, homeowners got foreclosures, not because governments preferred banks, because bond markets demanded it. COVID, same pattern. Governments borrowed trillions, stock markets soared, real estate exploded. The wealthy gained $4 trillion. Workers lost jobs, small businesses collapsed. But bond markets stayed calm because governments guaranteed asset prices wouldn't fall. Democracy would have distributed relief differently. Bond markets don't care about democracy. They care about portfolio returns. And governments care about bond markets more than voters, because bond markets determine whether governments can function tomorrow. Voters determine who stays in office. Bond markets determine whether governments can govern at all. When those conflict, bond markets win, every time. So, is there escape? Could governments balance budgets, stop borrowing, free themselves from bond market control? In theory, yes. In practice, impossible. Modern states are built on deficit spending. Defense, social security, healthcare, infrastructure all cost more than tax revenue covers. Balancing budgets would require massive tax increases or massive spending cuts. Both are political suicide. Voters say they want responsibility, but they vote for whoever promises more benefits without higher taxes. So politicians borrow. Bond markets enable it. Until debt grows too large, then bond markets demand austerity. The cycle repeats. Forever. Another option: print money instead of borrowing. Governments with their own currencies could create money to fund spending. No debt, no interest, no bond market control. But inflation is the price. Create too much money and currency value collapses. Weimar, Germany, Zimbabwe, Venezuela. So governments choose the bond market instead. Slower, safer, but surrender sovereignty in exchange. No escape. Only trade-offs. Democracy or solvency. Sovereignty or stability. Freedom or financing. The bond empire offers a deal. We'll lend you the money to govern, but we set the terms. Governments take it. Every time. Because the alternative is immediate collapse. August 2011. Standard & Poor's does something unprecedented. Downgrades U.S. government debt from AAA to AA+. First time in history, American treasuries are rated less than perfect. The reason? Political dysfunction. Congress nearly refused to raise the debt ceiling. The downgrade was a warning. Even the United States answers to bond markets. It worked. The threat of rising costs forced negotiation. The ceiling was raised. The message, bond markets can discipline even the world's superpower. If they can veto American policy, they can veto anyone. The future is already here. Global government debt, record highs. Bond markets, $130 trillion and growing. Central banks, buying bonds to keep rates artificially low. But every intervention has limits. Central banks can't buy forever without triggering inflation. Bond markets know this. The empire is tightening its grip. Governments are more dependent than ever. Democracy operates in an ever-shrinking cage. Some predict collapse. Bond bubble bursts. Rates spike. Defaults cascade. Chaos. But chaos never favors the powerless. It favors those with assets, gold, offshore accounts. The very people bond markets protect. More likely, the system evolves. Central banks and bond markets share power. New constraints replace old ones. But the fundamental structure remains. Democratic governments subordinate to unelected creditors. Because replacing the bond system requires trust, and trust takes generations to build. For 80 years since Bretton Woods, bonds have been the foundation of government finance. Unwinding that without catastrophe is nearly impossible. So the cage remains. Maybe bigger, maybe different bars, but still a cage. Here's what you can do with this knowledge. See clearly. Understand that every political debate happens inside boundaries set by bond markets. Every campaign promise requires bond market approval. Ask the questions nobody wants answered. Why do we accept elected government subordinate to unelected creditors? Why is fiscal credibility more important than democratic mandates? Why do bond markets decide which promises live and die? These aren't radical questions. They're obvious. They only sound radical because the system has made them invisible. The bond empire's power isn't natural. It's constructed. A system we built. Systems can be rebuilt. Countries could finance through central banks instead of bond markets. Risky, but possible. Countries could default and accept temporary credit exclusion. Painful, but survivable. Countries could cooperate to regulate bond markets. Difficult, not impossible. There are alternatives. But they require questioning one fundamental assumption, that government solvency matters more than government sovereignty. That's the question bond markets don't want asked. In 2011, Silvio Berlusconi stood in his office, still prime minister, still with parliamentary majority. In trading rooms across Europe, bond traders watched Italian yields hit 7%. Within days, Berlusconi was gone. Mario Monti was in. Democracy had been overruled. No vote, no coup, just interest rates. History doesn't repeat. It reveals. And it's revealing a simple truth. Elections are real, but they're not sovereign. The bond market is sovereign. Your vote is advisory. The $130 trillion empire didn't conquer democracy. It bought it, one bond at a time. You thought you lived in a democracy where voters choose priorities. Now you know the truth. Bond markets choose priorities. Voters choose which politicians deliver the bond market's agenda. Welcome to the empire, the invisible one that's been ruling all along,